So unlocking capital, empowering Canadian companies for growth, and it also said and success, but I had to trim that word off. So we are with, so let me just get to the session. Here we go. So we're with Rishi Chakraborty from McLeod Law. He's a partner. He works on a lot of equity situations and positions, acquisitions as well. And so a lot of deep expertise there. We also have Justin Hunter, who's the Associate Vice President of Commercial Banking across Alberta for National Bank. So delighted to have these brain trusts in the room with us. In terms of the session we're focusing on, this masterclass is going to explore the critical role of raising capital for Canadian small and mid-sized businesses. We'll highlight the importance of both equity and debt financing, and our expert speakers will outline the challenges SMBs face in accessing these funds. The key focus will be on sharing valuable insights, innovative structures, and opportunities to overcome challenges. You'll leave feeling empowered. Wow, that's a powerful word. And equipped with the effective capital raising strategies to ensure the long-term success of your business and organization. Don't miss this session, it says here. So I'm going to leave it to you, but thank you very much for joining us, guys.
Perfect. Thanks, Simon. It's a pleasure to be here today. Nice to see everybody, and glad we have a bit of a crowd here at 3:30 at the end of a long but very informative day. My side, obviously, being the banker, is I'll be focusing shockingly on the debt side. I'll just maybe get you to flip it to the next slide. I think, oh, no, that's right. So what I really wanted to say before the break there was kind of talk about today is, again, there's a lot of probably businesses here in the crowd here today where you've approached a bank when you were more at maybe a startup level, or you're kind of the point where you're getting close to growth or scale up, but aren't quite there, and maybe either didn't have a great experience, or maybe those products that are set up for you aren't maybe really appropriate for where you're at right now with your business. And it starts with working capital. I'm sure that's been preached and talked about repeatedly here today, so the importance of working capital. And what I wanted to talk about here is operating lines of credit particularly. They can take all shapes and sizes, but I do find there's a lot of scale-up type of businesses that either have been self-financing their operations, by that I mean not having any type of operating line at all, or have, say, something that's probably was good for them when the first couple of years, let's say $100,000 or $200,000 line of credit, now you're doing 5 million sales plus. So just being aware of the fact of banks, when you get to the scale-up mode, probably a lot more options available, and that includes margin lines of credit. And by the margin lines of credit, that's basically taking value from your accounts receivable, anything under 90 days. Typically, about 80% of that we can factor into a margin. Also, if applicable, if your business is dealing with a fair amount of raw material and or finished inventory, we can look at adding an inventory component to that borrowing base. So long story short, without getting too banky and getting too technical, it's the operating lines do allow the scaling companies capital to fuel growth while covering gaps in your cash flow. Inevitably, if you're trying to self-finance, there's going to be some times where you're going to be mobilizing on projects and you're going to be a little short of cash. You got good accounts receivable, you have good collection practices, but you just aren't quite there with the cash position. Well, guess what? You can unlock that with an operating line of credit, which is really powerful, fairly simple, but very powerful. So really just wanted to kind of introduce that more than anything. And again, open to questions either, as we go through this presentation or one-on-one today, or, through the next few weeks for that matter. So something I just want everyone to be aware of, that's a pretty powerful tool. So I'll maybe have you take it to the next slide. So part and parcel with that is, we'll go through the slide. I'll go through the slide in a fair amount of speed, is letters of credit and letters of guarantee. As I talked about in the first slide there, we have operating lines that actually are margined by accounts receivable and inventory. You can actually, for letters of credit, and you'll see, I'm sure some of you in the crowd have had LC requirements if you have development permit related, construction related sort of projects. For the city of Calgary, for example, they're looking for some type of performance bond or guarantee of sorts, and that's a letter of credit. Usually, we see letter of credits like, oh, I got to pledge cash, and that's going to really kind of impact my cash flow. a lot of times in these sort of situations, we have a margin line of credit, we can actually carve it out of the line of credit. So instead of having to pledge that cash, you have that cash still available. You're margining off of what your short-term assets look like. So that's a very common thing that I think a lot of people aren't aware of, that there actually is an ability to set up a line of credit that can kind of cover that off. And then I will say, and I won't go into too much detail on this side, I know for sure this would have been discussed in the, if any of you were in the EDC presentation, I think just there that concluded, documenting letters of credit, where you're looking at expanding abroad, or looking actually at importing, supplier sort of importing whatever goods you need, your inputs, to facilitate outputs. Often there's actually a pretty powerful tool of getting an import LC set up. Again, could be carved out of the line, provides you a little more ability to negotiate better terms with your suppliers abroad, where obviously they're comfortable that actually they're going to get paid at the end of the day. So want to go through that pretty quickly. I kind of mentioned EDC, is that EDC also, and some, if you're looking at export function, can tap into an account performance security guarantee, which can also, if you qualify, can be provided in lieu of cash when it comes to a letter of credit. So just making everybody clear that there's these sorts of options available when it comes to LCs and LGs. So I'll get you to...
Justin, do you want to see if, I'm curious, is there anybody in the group that have used these options, familiar with the options? Any experiences to share?
Not of them. One of the challenges I think is a company that's trying to capitalize scaling growth, how these are viewed by new investors. And so when you start putting debt vehicles, they help you with your day-to-day, they de-risk the day-to-day. But often, especially given the shift in the tides, and especially from a Canadian perspective being a bit more conservative, as soon as you start to load up on that side, it starts to get you further away from potential capital events because of these vehicles. That's the feedback we've had.
Because we find a lot of times, especially with the import LC, it actually just opens up a little more flexibility from a working capital position a lot of times, right, where you have a little more, say, flex when it comes to your supplier, your terms, all those sorts of things. But, everyone's got different sort of experiences with that, right? So, but just say some tools at your disposal at the end of the day that you can tap into. So,
I think they're necessary, just to be clear. I think that
yes.
you're not considering all these all the time. You're not putting your company in the best position.
Absolutely, yeah.
It depends where you're on the raise side of things. If you're not raising for a while, fair enough.
Yeah.
If you're raising, then it begs more questions than answers.
Yeah, it's not a one size fits all, right? And that's the thing too, like kind of your point taken is the fact of like, when I even present a lot of these banking options, it's, it doesn't always fit for every borrower, and each borrower has its own sort of unique circumstances, opportunities, challenges, all those sorts of things, right? So it's always a bit challenging as a banker to say, okay, this fits for everybody, this doesn't, but that's where the power of the conversation is, like kind of one-on-one and kind of figuring out, kind of customizing maybe what's going to fit for you for sure. So, so yeah, we're to the next slide here, and just as where I want to spend most of the rest of my time and my conversation is, I mean, again, fairly straightforward stuff. We're not splitting atoms here by any stretch of the imagination, but again, kind of consistent with the working capital piece. A lot of the businesses here today that maybe were approaching banks earlier on in their trajectory. There's a lot of really good options when it comes to to term loans and the flexibility. If you're well-capitalized business, there's a lot of flexibility when it comes to commercial buildings. Used to be you'd have to frankly go to BDC to get even close to 25 years amortization. You can go to a bank like National Bank, and more times than not, assuming the economic useful life of that building is at least 35 plus years, you can look to have amortizations past at least the 25s, which is really puts a lot less pressure on your working capital position. Upwards of 100% financing. Again, used to be back in the day. BDC used to be kind of the only one that could provide that. If you have a strong balance sheet, sustainable cash flows, predictable somewhat cash flows, we can really tap into that. So that can really unlock some capital for you right there. And then the equipment side, obviously as you're scaling, you probably needed to upgrade fleets or expand fleets, whatever have you. Lots of different programs available, expand, going upwards of 7, even sometimes longer than that, amortizations. not only for maybe taking out existing capital lease debt, but we can also provide some non-revolving CapEx facilities. So if you're ongoing, you need some more, you need more, you need to expand your CapEx program, that you have something available and it's neat and tidy and you can tap into through the year, which is pretty handy for sure. And then the last bit here on this slide would be the, opportunity. Some cases we can offer interest-only moratoriums. So, if there's a bit of a shift in your business and you want to have a little bit of working capital support or relief for a period of time, we can look at 3 months, 6 months for new buildings. We can look at well over a year in a lot of cases, which is pretty cool too. Again, a lot of these tools weren't available even a few years ago, but it's become a lot more, there's a lot more options that's available for those strong, well-capitalized companies. So this stuff to be aware of, and again, more than open to answering questions here today, or again, having more conversations on a one-to-one basis. So with that, we'll move to the growth by acquisition. This is where, of course, a lot of scaling companies are really tapping into. It's called what it is. We all hear about the silver tsunami that's coming up. I've read different sort of stats of late, and I kind of saw before COVID it was like 50% of businesses were looking to transition in the next 5 years. Of course, COVID happened. That kind of delayed a lot of the transfers. Obviously, as I called it back in the COVID days, the exercise for a banker trying to normalize cash flows was an exercise of futility. So a lot of things didn't really happen then. Well, of course, now post-COVID, a few years. Guess what? Now I've read with different decks and presentations I've been part of in the last few months that upwards of 70% of businesses are looking to transition in the next 10 years. About 50% of those are looking to transition externally, not within the family, like a third party. So here's a great opportunity for scaling companies to tap into different sort of financing programs. I'm sure through yesterday, through today, and through the next few days, you'll probably learn more. I'm sure the tuck-ins and bolt-ons and roll-ups, but I mean, different sort of sayings or sort of categories for what the opportunities may be for an existing business. The tuck-in, obviously, would be involving one small company integrated into a larger company. So here, actually, those scenarios where you're well capitalized, you're looking to buy a competitor, let's say it's a little bit smaller, tuck-in, meaning that we can tap into those cash flows that free cash flow you're already driving through your existing business to really be able to provide a lot of comfort on financing new acquisition, which i.e. means usually not a whole lot of equity required if there's really strong financials, really consistent, strong free cash flow. So something to be aware of there. We can be pretty, we can really kind of craft something that's going to work for you. Bolt-ons, again, this is where you're kind of buying another business that's, similar but maybe slightly different. Let's just, for example, maybe some type of vertical integration. We just dealt with a scaling company that was focused on cabinet doors, wall panels, those sorts of things. They're more of a distributor. They went ahead and they actually bought a manufacturer, obviously, and it's been obviously a lot of economies of scale there, of course, and being able to control their supply and everything else, which has really allowed that whole group to go to the next level. Through that, we're able to tap into what we call our management buy-in program, where there wasn't a whole lot of equity required up front, debt to capitalization. We're able to kind of go upwards of about 70% on that deal, which is pretty cool. So we get to roll-ups where you're kind of doing tuck-ins, but you're just, or whatever it is, bolt-ons, but you're continuing to acquire multiple competitors. The coolest notes here, without boring people to too many of the details, is that the banks now have, again, especially the last few years, really opened up a lot more options that are more amenable to your cash flow position being. It used to be kind of standard 5-year amortization, or if you got 7, guess what? That nasty cash sweep is coming in, and a lot of excess cash flow that you thought you had at the end of the year is kind of going to go towards that loan. We're kind of back to 5-year amortization. You can see here actually with National Bank, and to be honest with some other banks, getting upwards of 10 years amortization on intangible sort of goodwill, order book sort of lending is actually becoming more common. If we can wrap our head around that target, we're really comfortable with the buyer. There's some pretty cool things we can do. Again, we can even introduce some interest relief, or not relief, but interest moratoriums, those sorts of things. So again, it's really changed this side has really changed in the last few years. It used to be pretty uncommon to see, those types of terms. Now, to be honest, if we're not at, for the right opportunities at 8, 9, 10 years, we're basically out of market, right? So Devil in the details, but for something you should be aware of what we can tap into. So I think that covers off the growth by acquisition. I mean, that's where every situation, again, is very different, and is, you know, I'm sure one of the questions I would have on one-on-one or in a group would be, hey, how much equity do I need to put in? And, you know, it kind of depends on the situation. Again, if it's management buy-in, we have a lot of confidence in that transition period. We do figure that they've de-risked that transition period, and that risk is not very high. Typically, we can, you know, if the multiple's okay and everything else, we can allow a little less equity. Part of, I guess, not only bank financing, though, on these types of plays is obviously usually a lot of times we have VTBs, patient capital, that's helping sort of facilitate that transaction. We talk debt to capitalization, the numerator being debt. We actually usually don't typically include the VTB if it's deeply subordinated to the bank. So there's lots of different ways to get there. So it's just, you know, tools at your perusal to be able to tap into that. Frankly, were a lot more difficult to tap into even a few years ago. So, and then last but not least, I guess from my kind of slide deck, it's only 5 long here, is and a little bit of repeat, I guess, from those that have been in the EDC presentation here just preceded us. You know, here is where the kind of the theme here is that we're looking to unlock as many capital options as possible for our customers, and sometimes maybe the banks don't want to go it alone. It might be they want to de-risk the transaction, so a lot of times what they'll do is they'll bring in EDC. A lot of cases, if you're dealing with an exporter, to kind of de-risk it. It could be risk transference, where they're taking on pretty much all the risk, or we're kind of risk sharing. Different programs when you're looking, you know, abroad is the EGP program, trade expansion lending program. Those are kind of more kind of risk sharing sort of opportunities where EDCs provide like a 75% guarantee. So maybe, you know, having that as part of some type of term loan or operating line that maybe we wouldn't have done otherwise. If we tap into that guarantee, we're going to be a lot more comfortable in moving forward and providing that facility. Then we get into account performance security guarantees and FXGs. Essentially, those are mostly risk transference. Again, I'm not going to try to dig myself into a hole. I see Mark, you're in the background there, as to devil's in the details there. But the point being there is, I don't want to say anything that's incorrect, but my point here is that these are programs that our bank and other banks are tapping into to unlock more capital options for those scaling companies as you're moving abroad, et cetera, when it comes to a business perspective. Last but not least, BDC, we still work with them a decent amount when it comes to the kind of the pari passu co-lending program. Again, it's kind of more sharing the risk. You're in a situation where maybe the bank is like, you know, pretty solid company, but the risk profile is, you know, they're a little bit younger, or you know, it's a little bit unstable at times, or, you know, debt loads are a little bit higher. We want to kind of share the risk. So in that case, a lot of times we can tap into BDC, particularly from a land building perspective, and share the risk there, where they take half of the exposure, we take half of the exposure. So yeah, pretty cool thing to be able to tap into. Again, it's all about more, you know, offering customers that deserve it, that have a good balance sheets, or responsible owners, you know, good position in your industry, everything else. These levers to pull that, again, before that either maybe you weren't aware of, or maybe weren't as flexible as they are now. So with that, that's pretty quick, but that's kind of my main kind of formal presentation. I'll maybe open it up really quickly to a few questions. If you have any questions at the end of Rishi's presentation, that's fine too, but I thought I'd open up to any quick comments, questions, whatever have you. Oh, I think I bored everybody.
Justin, let me quickly ask you one. Your group at National Bank, what's the typical check sizes that you're working with?
So good question. So our typical kind of sweet spot is anywhere between, from a lending perspective, all in, so I'm including term loans, lines of credit, all the things I've talked about today, anywhere between about 1.25 and about upwards of 50 million. Where then we have another group, it's National Client Group, that's kind of dealing with the larger private plays. If they outgrow us, we can pass it on to our big brothers and sisters, essentially. But revenue-wise, we're kind of anywhere from, you know, typically $1 million upwards of 100 million. So pretty wide. We're kind of a jack of all trades. We try to be a master of most when it comes to those different types of opportunities to provide financing. So any other questions at this point? Or we'll move it over to Rishi and his equity discussion.
I'll try to be under 10 minutes. So very quickly, Rishi Chakraborty, I'm a partner at McLeod Law. You can see our sign there. We are in it with you. Okay. I practice in the business law group. I'll tell you how I tell my mom. I do three things. I work with mostly C-suite level folks and the board with their overall strategy. And believe me or not, legal is a consideration in your business strategy. And when I'm not doing that, I assist companies with financing options, largely on the equity side. And last but not the least, oftentimes are either exiting or they're growing via acquisitions or through some reorganization. So that's where I try to provide some value. And all of that intermingles and commingles with largely strategy. So that's me.
Maybe your clicker guy, just to share it off.
Sure, thank you. I tried to put this up there just to give folks over here an example of what are the flavors of the day, month, or year. It seems it's not the Holy Grail. There's obviously other instruments we see, but just quickly, is anybody in the room familiar with these terms, these instruments? Have they seen, use, and practice? Yeah, okay, I see a lot of nodding heads. Yeah, so I'm assuming most of the folks in this room or in scale-up would fall in that, if you're looking from top down, seed stage, early growth, and expansion. We work with, we see companies in all of those stages, and as a result, we work with all kinds of instruments and all kinds of investors and different stakeholders with different motivations. So yeah, so if you want to go to the next slide, Justin, thank you. So I'll quickly talk about, as you can see, it's pretty high level. I'll quickly familiarize you folks with what we are seeing in those instruments. I know I started with convertible notes, but before I get to that, there is something called just notes. They don't need to convert into equity. They're simply debt before the banks come into play. But it was quite obvious, so I didn't throw that in there. But given that we're talking about equity financing, I thought I'd talk a little bit about convertible notes and safes. So, as I've highlighted there, they're actually debt instruments that ultimately has a conversion feature. So think of it this way: Justin has a company, and I see the value proposition, and I see a growth perspective in his company. I don't want to simply lend money. I want to participate on the upside as well. And that's really what it is. It is an option given to me to convert my debt into equity should I choose to do it. As simple as that. Because it's primarily a debt instrument, it obviously has those features of a coupon rate or an interest, some kind of maturity date, and, as I said, conversion terms. I'm going to stand up. I call it popular for smaller rounds, but to be honest with you, what is a small round? I have seen that used in larger rounds, being 5-10 million up, depending on who your investor base is, what they like, to Justin's point to you, what is your story? So really, as I said, this is not the Holy Grail. It really is very context dependent. I wanted to give you folks a bit of a sense of timeline, because I'm sure as business owners, this is important time. How long will it take? How much is it going to cost? You'll see that I haven't put a dollar number. But usually we find, that 2 to 4 week range is when from, ideation to execution. Obviously, There might be other variables where it might be shorter, it could be slightly longer, but generally that's the ballpark. Cost, these have been done many, many times, so generally shouldn't be very expensive to do, but for the fact that if you have something very unique about your company and your investor base. SAFE stands for Simple Agreement. So there's nothing simple about it. Simple Agreement for Future Equity. This was an instrument that was actually created by Y Combinator out of the Valley. And it's become quite popular in the US in particular. I have not seen it as common, well, I shouldn't say that. I have seen it being used in Canada. I haven't seen it as commonly used in Calgary, in particular, or Alberta. There are definitely outliers. What has happened with this instrument is, you remember I said, I was being facetious when I said there's nothing simple about it. It's because when this instrument was created, it was created in the US. It's largely for US companies, US investors that are familiar with this instrument. And sadly, what we have seen is when that instrument migrated up north, people started using that document just the way it was prepared for US investors. And frankly, it doesn't always work in Canada. That's why I said there's nothing simple about it, depending on what kind of instrument you're starting with. But at its core, it's very similar to a convertible note. The only difference is it is not a debt instrument. Using the same example that I just used, I have a company, and Justin is interested in investing in my company, but we don't know what the valuation today is because I'm still pretty early in my stage of growth. So essentially what I'm committing to Justin is, if Justin wants to invest $100,000, I say that $100,000 roughly would be 10% of my company. But I don't want to give you equity right away, but I promise, essentially a promise, that I will give you future equity on certain events. So if I were to do a round, if I was to do some kind of financing, that's when that trigger happens, when Justin's $100,000 turns into 10% of, let's say, common shares or something of the company. That's really what it is. As I said, it's favored by founders because it is fairly straightforward, but it's a trap for the unwary sometimes, and just be careful when you run into a document like that. Have someone that you trust or someone who's experienced using a SAFE in Canada take a look at it or get their views on it, because sometimes it messes up your cap table. 1 to 2 weeks is pretty accurate. It's not very complicated in that sense. It's a fairly low cost because that instrument is pretty well understood, at least in the US. And it's, as I said, it's migrated to Canada. And if you're using the right instrument for a Canadian company, it should not be very complicated. Very quickly, we are now going to, if you go back to my very first slide, we are probably now getting to venture capital growth stage companies, A round, B, more I'd say B round, C rounds. That's where you start to see convertible pref shares. Again, similar to convertible notes, they are not strictly debt instrument, but kind of have debt-like features. But they are heavily negotiated. Because at the end of the day, if Justin was a venture capitalist, obviously he doesn't want to be with the rest of the great unwashed, so to speak, who came in as friends, family, and supported you in the early rounds. They are cutting those big checks, and they want to be treated differently than the rest. And that's why these are heavily negotiated. They have, the reason they're called preferred, because they've got preferential terms that you wouldn't see with the other prior rounds of financing. It's usually, you come in knowing exactly what your ownership position is, what your cap table would look like as a preferred share owner, if you were to convert, what that would look in the grand scheme of things. We usually see this a lot, as I said, with venture capital, private equity. It can be expensive because, as I said, you're negotiating terms, and no deal is the same. This is not a standardized one-size-fits-all kind of an instrument. It is very specific to the company. It's very specific to your investors. It's very specific to your board, your existing shareholders. So there's quite a few stakeholders to keep in mind. And as a result, cost can be high. Last one, getting to 4 o'clock. Last one is the simplest form. Everybody's probably familiar with this. It's what most founders own when they start a company. It's common shares. These are usually, we tend to see these on the very front end, or we tend to see them at the back end. So when I mean front end is when you've got friends and family coming in, and they just love you, and they believe in you, and they want to take the same risk as you have taken. So there you go. On the back end, you're extremely successful. Your valuation, everybody knows who you are. You're about to go public, or you're about to exit, or very close to it, and people see the upside in that, and as a result will come in with the same degree of risk as you are, full well knowing that some of those parameters of risk have reduced from the early round investors. It is, that second point is kind of important. If you recall, I said you are the investors are in the same bucket as you are. So it's not very popular when you are in the early stages of growth, or even the mid stages of growth. But at the same time, you should be mindful of, if you are giving out equity to your employees, to your consultants, to your board members, they will have a dilution effect on them. So you might want to be mindful of that. Again, the timeline for that is 1 to 2 weeks, and the cost is fairly low. Last slide, Justin. Yeah, the last point, it's pretty self-explanatory. As I touched on all of these more or less, this is what we typically see when we are talking to board members or founders or even C-suite as to, what should I choose? Again, this is not a exclusive list, but these are some of the common themes we tend to see. I'll just speak to one. The time, maybe I lied. I'll speak about two. Time to close and market conditions. Time to close is very important for investors as well as for the founder or the business owner. So that's a very important consideration. But at the same time, market conditions sometimes dictate what is the flavor of the day, so to speak. So there's several other things that play into it, but I thought those 5 are the key ones that we could think of. And I think that's it. Yes, sir. It really depends on the particular investor. So the venture capitals that I think you said the distinction between VC and PE is pretty clear. What I've tended to see in the US in particular, I don't know the differences as apparent in Canada yet or not, but what we tend to see in the United States, and particularly in the United Kingdom, is the VC world, it tends to go up to an A round. Sometimes goes into the B round, but mostly seed to an A round. I don't want to put dollar figures because they all tend to vary. But if you want to use a marker, seed to A round, pre-seed, you're looking at angel investors and high net worth individuals. But A round is where VC tends to end. BC, you're trying to get into family offices. You're starting to get more institutional. So you're starting to see family offices, high net worth individuals, and perhaps growth. Sorry, what was the term you used again? Growth. Growth equity, yep, that's probably where they would fit in. By the time you're in the C or D rounds, you're right into the realm of private equity.
I guess one of the nuances is sort of VC tend to let you run the business, it's a capital vehicle that you get institutional support. PE want a majority stake, they're very operational. I'm trying to figure out the flavor of GE in the middle. Because a lot of GE shops are calling us right now, but they want bigger check sizes than we're really ready for. And then I'm trying to understand the operational control element.
Yeah, not to sound facetious, I'm going to assume they're somewhere in between when the VC says this is beyond our check size and it's too small for the PE routes. but we have a client, they don't call themselves growth equity investors, but I would think, based on what you're saying, I would think they would squarely fit into that. And tell me if that's been your experience. They usually look at cash flow positive companies, somewhere around the 2 to 5 million, or even 10, I've seen 10 million EBITDA number, where you're clearly seeing that the company is in a growth stage, but hasn't quite reached that milestone where it can run on its own. Maybe they need a little bit of supervision, maybe they need a little bit more guidance, the board level execution strategy, perhaps that, maybe? Is that your experience? The lines are definitely blurred. There are many, many players in this space, and they all have their own investment thesis and their own approval committees, and yeah. Anything else? I'll quickly tell maybe while you're thinking about a question, and if there's none, that's totally fine. I'll just leave you with one thought. We often find folks come to us with a very set opinion that this is how I want to raise capital. And our recommendation or suggestion usually is, have you talked to your investors? Because they're the ones who are going to be writing the check. So they might have their own views and opinions about it. And maybe what you've already thought might not be a workable solution. So talk to your investor base, regardless of which stage of growth you're in. And I've forgotten my last piece of thought.
Well, when it comes to the investor side, when you're looking at the banking side, it's making sure that your key investors are aware of what you're looking to do as well, right? Because we've seen some situations where maybe that initial entrepreneur has got a little bit too far, and so checking in, regularly, making sure everyone's on the same page and understanding what the ramifications are of how you're going to capitalize your company is really important. But yeah, I mean, on our side, we see having it's a buy-side advisors, particularly when it comes to to growth by acquisition, is really important, right? Having that guidance, going through sort of all the little bits and pieces of doing your due diligence and making sure that you're prepared to know what you're buying. There's no skeletons in the closets, those sorts of things. So having those professionals, I would just kind of finish off with having as many professionals around the table as possible is really what a bank is looking for. Where I've seen sort of growth by acquisition where it falls apart is where kind of rushing. It was an LOI that's been rushed, hasn't really been vetted by a lawyer and or an advisor of sorts. And you kind of get closer to the end. You think you're at the end, and actually you're at the beginning. If you have a type of structure, a final share purchase agreement that's going to trip bank covenants, where there's more cash on close that we're comfortable with, those sorts of things. That's sometimes going to be 11th hour heartache for everybody involved. So, through today, I'm sure you've learned, to kind of think of everything, and having as many, say, professionals around you is always usually your best way to be successful and having a positive outcome at the end of the day. So,
I remember what I was going to say. Thanks.
I bought you time.
Yes. Short-term memory loss. On that point, tomorrow, as Simon mentioned, we are hosting a session and advisory session, Simon? Okay, he's pointing to me as water. No, definitely not. You're at a law firm. There will be more than just water. Yes, and so if you have any questions that comes up, or you just wanted to chat with us, we'll be there. So happy to have continue this conversation. Or if you just wanted to just say this presentation was boring, that's totally fine too.
I'll be hanging out as well over a cocktail, courtesy of McLeod. Thank you in advance for those great options you're going to provide us. But in all seriousness, there's another opportunity over a more casual environment too. If there's anything you may be thinking about on the drive home tonight and you want to ask me, or you just want to have a chat one-on-one, I'm absolutely there. Or we can obviously get the conversation going tomorrow, and then obviously look at a more formal kind of sitting down, get an understanding of what you're at, where you want to be, and we can see what we can do to unlock some options for you. So thank you, everybody. I think we'll give you back a solid 15-ish minutes or more. So happy commuting back home. Thank you, everybody.
That's awesome. Thank you so much, Justin and Rishi.